Hey, good morning, guys. Welcome to Market Mondays. Hopefully, you guys had a great weekend. We're going to fill you guys in on how the Fed meeting went last week and what it all means, what the Fed intends on doing with the Fed funds rate, and go into some things that are going to be happening this week as well. So, before I get right into it and do a quick dad joke that I just found, which is pretty funny. So, I went on a date with this girl and we were bird watching, but the way she counted birds was kind of interesting. There's something about it. She went hawk one, hawk two, and that's a joke. Hawk two. We getting it? All right. So if you guys don't get that joke, it's a reference to an Instagram video that got really famous. Anyway, hawk two is the video, I think. There's a hawk to a girl, if you guys don't know the reference. Anyway, getting right into it. Went a little too far with the explanation on that, but getting right into it. As far as the Fed meeting that went on last Wednesday, there were some really important details on how the Fed felt about our American economy and how they intend on they made some changes on their speculations on where the economy is going and what they intend on doing with the Fed funds rate. So I'm going to show you guys kind of what's called something called a dot plot. Now, this dot plot represents how the Fed is feeling, each member, how the Fed is feeling about their what they plan on doing with the Fed funds rate. So it's really important to know like how that works out. But one of the things that we want to show is that where everyone is at in relation to that dot plot. So I'm gonna give me some adjust my screen a little bit. But sorry, back to what I was saying as far as this dot plot goes. So each dot, so this is the year for 2025, 26, 27, 28. So in 2025, back, let me make sure I'm showing the right year. All right, so this is 2000. So this report was given out to us in December at the end of last year. So at the end of last year, the Fed met and and this is how they felt about where the Fed funds rate is going. Now, this is year 2025, 2026, 2027, and so on. Now, again, this is when they made this decision back in December of 2024. Each dot plot represents where each dot is what each member of the Fed, where they feel like the Fed funds rate is going to go, or where they think the Fed funds rate should go. So one member believes that the Fed rate should go down to 4.5, 4.375. Three members plan on going to 4.25. Almost 9 members basically think it should go to around 4.0 ish. And then we have 3 members at 3.5, and so on and so forth. So we have all these members that are looking to see where they feel like the Fed funds rate should go by the end of the year. Now, so if you kind of look at it, most of the dots, they believe that the Fed funds rate will end up around the 3.875 range. That's where they believe that the Fed funds rate should go. Now, what's really important is that you kind of notice that, it's most of their decisions, most of them are in this range. And then we have 3 here and 1 here. Which is kind of interesting to see where like there's one person that thinks we should go down to 3.0, which is crazy. But if we look at the change from what they've decided in 2000 at the end of the year of last year in December 2024, and what they changed with the big change as of last week in March, you can kind of notice that it's completely different, right? If you kind of compare the dots, is that most of them still believe, we should be in just like the 3.875 range, but more so that a lot of them believe that we should be 3.875 or in between 4.5. That's a really big detail because a lot of them have changed their mind based on how the economy is going, based on inflation, based on unemployment rate, so on and so forth. A lot less of them think that the Fed rate should go below 3.75. So that's something that kind of we're seeing moving forward into the rest of the year, is that they probably won't change the Fed rate by that much. 4 of them believe it shouldn't be changed at all because we are currently at 4.375. A lot more of them probably see us between 4.25 and 3.75. So that kind of gives you a clue as that for the most part it didn't really change as far as the majority of where they think the Fed funds rate should be at from 2024. But you can definitely see that a lot of them have shifted to say that maybe we should stay in the higher range, or maybe not change it at all moving forward based on how the economy is going. So that's really important to see, and how we expect the Fed funds rate is going to go for the rest of the year. Another thing to kind of bring up is what the Fed believe where the unemployment rate should go. So the dotted line here shows what the Fed was feeling back in December of 2024 and how they're feeling now. Back in 2024, in December of 2024, a lot of the Fed members believed we were not going to go past 4.3% on the unemployment rate. That has completely, and then very little of them, maybe 4 or 5 members, thought we were going to go past 4.4 on the unemployment rate. That has completely shifted, where now they do believe that unemployment rate is going to go up to 4.4, 4.5. And there's actually a member or two that believe that we might go past 4.6. So it's completely shifted in where they think the unemployment rate is going to go. They do think it's going to go higher, which is a big deal. Now, how do these all impact our economy moving forward? Well, as more and more, we're seeing more and more projections that the unemployment rate is going to continue to go up. And now a lot of the Fed members think it's going to go up to 4.4 to 4.5. But why that's really important is because it only further reinforces how rates are going to behave, such that rates are going to still continue to go down. So really, it's just showing evidence that even the Fed thinks the unemployment rate could go even higher. As we notice, every time the unemployment rate has come down from the previous month, the mortgage rates have gotten better. So if this projection is true and more is shifted toward the higher unemployment rate, we could see rates continue to come down as well. Same thing with the Fed funds rate. The Fed funds rate, as it's maintained higher, it's going to have a longer lasting impact on inflation coming down. So as the Fed funds rate remains high and the inflation numbers come down, that's also going to help mortgage rates get better throughout the year. So that's really what's important, is that mortgage rates are expected to get better based on these projections of what the Fed believes the economy is going. These aren't actual what the numbers are going to be, because we don't know. Again, these are all projections. Same thing with the Fed funds rate. They just based on how it's going, this is where they believe it's going to end up. So even the Fed believes that the unemployment rate is going to continue to go up, and we may not need that many cuts. We maybe do 1, 2, maybe 3 at most in the cuts of the Fed funds rate. So just goes to show that the current economy that we're in is only projected to get worse and worse. So, and they're already talking about recessions finally again, I guess, which we've been talking about since into 2023. So it's coming. I'd say it's coming, and unemployment rate still remains above 4%. So that's what's really important about those details about the unemployment rate. As far as rates go, they've, for the most part, have been trending in a more sideways direction. They might have gotten a little worse, but not by much. So if we're looking at the numbers as far as the unemployment, as mortgage rates go from a week to week basis, there's not a huge change in that per se. We're still hanging around, the low to mid 6s, if we're really being completely honest of how everything's going. So if you look at this chart, for the most part, we've been, since beginning into February, when rates started to get better, we're pretty much sideways since then. There's really not much change. Of course, we're a lot better than we were at the beginning of the year, which is really good. So as long as we maintain that trend of it continuing to go down, this is beginning of year of 2025. If I were to zoom in a little bit, this is where we're kind of comparing, the height of the mid-January where it was the highest, and then it's slowly trending down. So hopefully that helped you guys, gives you some insight as to what to expect for the rest of the year. Again, if the unemployment rate continues to go down, inflation continues to come down, mortgage rates are expected to come down as well. So we got some room, which is a good thing. We might see numbers back what we saw in September again, which is really exciting. Otherwise, that's all I got for you guys. Look out.